a little bit of time this morning to participate in today's webinar. Just a couple of housekeeping items. We'll probably talk for about 30 minutes this morning, and if you have any questions, the audio function is turned off, so you can just type in your questions. I will be tracking them through the chat function and addressing them through the presentation. But really, the goal of this morning's presentation is really not to say anything revolutionary apart from what we've said over the past few years, but just kind of give some talking points and some things to contemplate as you're working with your clients during this tax season. So I apologize, my screen popped up there. And so what I want to do is really talk about our three areas of our firm. One of them is the R&E credit, which I am the director of. Talk a little bit about cost segregation, just from the standpoint, I know Dave has a webinar next week, just in case, get some of the low-hanging fruit there, just in case some of you can't participate in next week's webinar about fixed asset products. And then the end kind of on the DISC, the IC DISC, the export incentives. So go ahead and just, for those of you who don't know, McGuire Sponsel, we are a specialty tax firm, works with over 90 firms in 22 states now. Really, our model, as many of you know, is to serve local and regional CPA firms, be the specialty tax department. We do that primarily out of our Indianapolis office, where everyone's located, with the exception of one of our colleagues, Mike D'Alessandro. He's a principal in our firm located north of Philadelphia in the Lehigh Valley area, and he really manages those relationships out there. But and like I said, once again, for those of you who don't know, Dave McGuire and I formed the firm. Dave and I have been together since early 2005. Dave came from the Big Four out of New York. I came from a local firm here in the Indianapolis area. I have the tax background. He had the engineering background. And so Dave oversees kind of our fixed asset practice, the cost seg, 179D, fixed asset review practice. I oversee the R&E tax credit practice and the IC DISC practice. Like I said, today's agenda is I'm going to give you some talking points, some things to consider on the R&E credit, touch on cost segregation, and then just walk you through the IC DISC. That is obviously, some of you know have been working with us over the years. That is a new practice for us and something that we've been offering now, entering our second year doing, and we're very, very excited about. The R&E tax credit. I want to touch on a few things because this credit, as those of you who've spoken with me before, I call this a permanently temporary credit. Okay, this is a tax credit that rewards you and your clients based on developing new products, new processes, new technologies. It's been around since the early 80s. Was first rewarded revolutionary credits. Then in December 2003, they came out with some further guidance that permitted it to be reward evolutionary, meaning no longer did things have to be new to your clients as long as they new to your client's industry. It just needed to be new to your clients. But what happened in 2010, some of you may recall, is that we had the Small Business Act, and it was a great year for the credit because due to the fact that the R&E credit has always been a general business credit, it only offset regular tax. It didn't offset taxpayers that were subject to minimum tax. And so there would be clients that were just kind of trapped in this purgatory of AMT and never allowed to use their credits, and their credits always would just be they would be carrying their credits forward. In 2010, they loosened it and said, gosh, if a taxpayer is under $50 million of revenue, they should be allowed to use all their credits in that year. So for 2010, we had this, the general business credits could offset AMT. Unfortunately, that was only for 1 year. It was only for the 2010 tax year. So for your clients that for 2011 and beyond or prior to 2010, it's still that regular tax is what we're looking to offset, not AMT. One thing of note, though, if you have clients that generated tax credits in 2010 or did not take the advantage of the tax credit, the R&E tax credit in 2010 and still could, those credits from the 2010 tax year, whatever credits generated from the 2010 tax year offset AMT regardless of the year you want to apply them against. So if you have a client that is generated tax credits in 2010 or did a project that they could incur some qualified research expenditures in 2010, and that's to generate a tax credit, and they didn't make money in 2010, those credits could carry forward to 2011 and offset 2011 AMT. So that's just something to keep in mind. But also worth mentioning is this tax credit rewards product, process, and technological developments, okay, as well as manufacturability initiatives. So, we have, and I'll show in a later slide, we have a wide variety. I mean, as a firm, we probably will do over 100 studies in 2012 for the R&E credit. That covers, probably 14 or 15 different industries. So when you look at it from from people that design, build machinery, to people that develop manufacturing processes, to a foundry operation that is trying to deal with manufacturability and issues. This credit rewards those clients for those companies. But what's important is this is much more of an engineering discipline than it is an accounting discipline. I was on the phone this morning with a CPA in the Midwest, and they have a client that we've done their work for the past 3 years, and their CFO wants to take the credit, wants to calculate the credit internally this year. Well, the challenge with that is that they don't have the engineering. They can't really build a qualitative case. They're going to take what they call a trial balance approach, and that's that's their prerogative as the client. I would still encourage anybody taking advantage of this credit to make sure they pay attention to the qualitative issues, creating that nexus, that link between a qualified event and the expense. Because for companies that qualify, we're still talking about a 5 to 6.5% benefit, meaning that the credit is typically about 5 to 6.5% of their expenditures on an annual basis. I want to talk about some myth busters related to the credit, okay? Most people, I can't tell you how many times I sit down and talk to a client, and they think, well, I'm designing and building a product or a piece of equipment to sell to a customer, okay? So therefore, that's not R&D. That's my customer's research. And I always want to remind clients that this is something that you are granted the opportunity to claim the R&E credit if you are bearing the economic risk for the project, meaning if your clients are charging for work, okay, they are still going to be able to claim the credit if they're only paid when they're successful. The key thing is, are your clients who are having engineering, they're having scrap issues, they're constantly developing new products, are they bearing the economic risk, meaning they're only going to get paid if they're successful? If that's the case, then that kind of unlocks the first door for their opportunity for the R&E credit. If they're just paid time and material and they're just paid on attempt, then that really eliminates their opportunity for that specific job. The second issue is substantial rights. I talked to a client and they said, TJ, we do work for our clients and they pay us on a fixed price basis, but this is their technology. This is their product, not mine. The IRS states that as long as a taxpayer maintains rights to be able to use the technical knowledge that they gained during a project and have that available for future projects, then that unlocks the second door. So it's important for your clients to maintain economic risk for a project to maintain rights to the technology or to the knowledge that they gained during that project. But what's important is, a lot of people think, well, gosh, you know what, I go out and participate in bid and proposal time, and I spend time technically concepting and drawing up a piece of equipment, I don't get the job. Or I tried 10 times to do something and I wasn't successful until the 11th try. The IRS does not reward a taxpayer on their successes. They reward them on their attempts. Okay, so when you have a client that is working on something and they are not successful at it, does not mean that they can't take the credit. Actually, failure, I used to hear somebody tell me that failure is one of the greatest signs of for the credit because it proves that there is uncertainty. It proves that there's a risk. So you're rewarding your attempts, not your successes, and not just your successes. But and also, in addition, I talk about that 5 to 6.5% benefit. What we all need to keep in mind is state research credits. For many states that you got Indiana has a great credit. I won't go down through all the list, but there's several states that have really good credits. Some states have refundable credits, meaning they'll pay you, they'll give you credit even if you don't have taxable income. In the state of Georgia, if you're the first 5 years, if you're a company in its first 5 years, you can utilize your credits to offset the payroll withholdings. So payroll tax withholding. So these state credits is something you should not overlook. Plus, state credits often aren't limited to AMT. You know, in Indiana, you look at it, and I have clients that benefit more from the state credit than they do the federal credit because it's not subject to AMT. So that's something important. When you look at your client's opportunities, it's just not from the federal standpoint, it's also from the state. But, and also for when I bring up that AMT issue again, because that's very important, is that if you have a client that's not been taking advantage of the credit because of AMT, it may be worth considering to look at the R&E credit solely for the state purposes. Okay, give you a picture, get your minds thinking in terms of the clients, the potential clients, the prospects that you may be working on that have opportunity. Design build probably are, besides defense contractors, design build companies are probably one of the cleanest opportunities for the credit because they're rooted in engineering. You know, I was spoken to a design build shop down in Alabama this morning, and I mean the R&E credit was intended for them because they are really pushing the envelope from a technological, from a capability standpoint. Food manufacturers, you know, you got this constant push. You know, food manufacturers is always kind of something we all puzzled with about 5 or 6 years ago because so much of food is taste and preference items, which the R&E credit really doesn't want companies taking the credit if their initiatives are solely driven towards taste or aesthetic or cosmetic purposes. But with food, you know, with this push with organic and whole foods, it's really opened up a whole new opportunity for not only taxpayers to grow their businesses, but for the R&E credit because we're dealing with new ingredients and new chemistry, basically. Obviously, software development, defense contractors are good. Architectural firms, we have a handful. You know, there's been a lot of marketing literature out there in recent months from other boutique firms boasting about how great architectural firms are, how great architectural firms and engineering firms are for the credit. And it's very important to keep in mind that that while their opportunity isn't as clean as a defense contractor or design build manufacturer, that it is still a good opportunity, but we must be much more diligent in identifying those opportunities. Chemical manufacturers are great. I mean, obviously chemistry there's a lot of uncertainty when dealing with chemistry, and then when taking small batches and going to large batches. Contract manufacturers are good opportunities. The key thing on contract manufacturers is how they're paid and who maintain rights. Is that for those contract manufacturers that have get paid fixed price and they maintain rights to the knowledge they gain, then it absolutely is a good opportunity for them. When we look at the R&E credit for your clients, what's important to consider is that your client is rewarded for their entire development cycle, okay? So from really concept through to commercial production. So this slide I wanted to illustrate and just get you thinking about all the different people because this is a wage-driven credit. A lot of the dollars that get generated in the form of a credit are going to be wages. So this gives you an idea of, when we look at it saying, gosh, technical sales, quality control, the guys out there on the shop floor doing the tooling. But really the epicenter of your client's opportunity is going to be the argument of routine engineering versus qualified research. Okay, the goal of our study in building a qualitative claim to prove that qualified research exists within your clients is the ability for us to demonstrate and prove that there is a technical risk of failure, that there is uncertainty related to the design, engineering, and functionality of a product, a process, or a technology. And when you're talking to your clients and meeting with them and they start talking about engineering, or maybe they lost a lot of money on a particular job, if you hear that they're doing prototyping, they're spending a lot of time dealing with quality control and validation work, if they complain of scrap issues, if they have, when I put the term yield, if they have poor yields, those are kind of buzzwords for R&E. Once again, so like I said a few minutes ago, failures demonstrate research. Not from human error necessarily or just an oversight, but in terms of true uncertainty. But never forget the role of technical management and salespeople. A lot of people just, when they think of the R&E credit, they think of their engineering department, okay, that person that makes $50,000, $60,000, $80,000 a year. What they forget is that you got technical salespeople, you have people that are involved in management that provide guidance, insight and oversight in a project, we can allocate the percentage of their time that is spent doing that. Software development, big thing here I want to point out to you is that we're talking about when it comes to software development, it's obviously a good opportunity for many clients, but there are some differences between internal use and external use. If it's internal use, it's much different. If they're developing their own software to track inventory or costs, that's much more difficult as opposed to a company that's developing software for sale. When we talk about ongoing development of existing software, it's important to keep in mind that maintenance, debugging issues, programming costs, investments related to those are not going to be includable. We're just talking about true development, adding new features, enhancements. When it talks about kind of software, if it's more analytical software, that's a good thing for the credit. If it's more of gathering software, like software that's there to collect Scantron sheets that you used to use in school, or tally election forms at the polling sites, that's not usually too great of an opportunity as much as analytical software is. 3 costs, once again, quickly: wages, supplies, and contract research. Important thing is once we have a project qualified, we've got to be able to provide nexus between the event, the qualified activity, the person, the wage, the raw materials consumed, and the third-party research. One thing to remind about contract research: if your clients are pursuing patents, the cost of pursuing the patent, what they call the patent prosecution, is an includable event. There's 3, just to be sensitive of everybody's time, I just wanted to kind of get going here on the calculation options. There's 3 different calculation options. The first 2, the standard calculation, the startup, are based off of revenue. We have to pull this base amount out and compare it to your client's revenues. But the alternative simplified is what really a lot of our clients are switching to, because it makes it much easier to document and to provide a clear case that your clients have qualified research and the calculation strong. And that is basically using a 3-year average, rolling average. So we compare 2011 QREs to 50% of the average QREs of the 3 previous tax years. You still have a credit and then an effective credit. What the difference, for those of you who don't know, the gross credit, that credit amount is what you add back to taxable income before taking that $33,000. The effective credit is the 280C election, which allows you not to have to add back the credit to income. So your deduction stays as deductions, and your credit stays as a below-the-line item tax credit. Just quickly, cost segregation. Like I said, Dave's going to speak about this next week, but I wanted to touch on it because I was out with a couple clients this week down in the Florida area, the Central Florida, and just kind of was reminded of the fact that sometimes people forget what a good opportunity cost seg is. The bottom line is a cost that people ask TJ or Dave or somebody in our firm, what makes a good cost seg opportunity? Ideally is that $1 million building. $1 million building is a good number. Okay, in terms of your client builds $1 million building, a cost seg probably makes some sense for us to look at. However, it really depends on the type of a building. If you have a client that's built out a $600,000 dental office suite, okay, that makes more sense because there's more opportunity. If it's a $1 million pole barn, it probably is not that great of an opportunity. So once you start looking at Class A, Class B office space, manufacturing facilities, it's that high 6 figures is what you're looking at. If it is a more distribution facility, it's going to be have to be a higher threshold for dollar amount to be invested. If it's a climate controlled situation, cold storage facility, or has clean rooms in it, those areas are going to be a lot more applicable for cost segregation, because cost segregation, and I'm borrowing this slide from Dave. Basically, this slide demonstrates would you rather have those deductions, those non-cash deductions, in the first 7 years of owning a building, or would you have them over 39 years? Obviously, it's a net present value issue, but this slide just demonstrates the benefits of a cost segregation, pushing all those non-cash expenditures up. As I was with a CPA yesterday talking to a client about cost segregation, the CPA pretty much told the client, 39 years from now, or 30 years from now, I think is what the term he used. It's not the building's not going to be that person's issue. It's going to be probably his children's issue. So take the known tax savings now, and then what happens 30 years from now, at least reap the benefits now. Types of cost segregation studies, obviously new construction's and much easier. You have the blueprints, you have the construction budget, but also we can go back and look, and if you have a building, a client that's maybe collected a group of buildings over the past 4 or 5 years, we can go back and do a catch-up adjustment, a 481A adjustment, filing a change of accounting method in the current year, and catching up all that missed appreciation, which provides a tremendous tax savings opportunity for your clients. What makes a good prospect? Obviously, when you have the R&E credit, you have AMT as kind of that can be kind of like the kryptonite, if you will, for the opportunity. For a cost segregation, it's passive issues if you have passive shareholders, because obviously there's limitations there in terms of the deductions you can take. But this is something to consider, obviously, when you have buildings that maybe you don't own the building, but you're doing the build out. The leasehold improvements, if you have a client that has a lot of leasehold improvements on the books. But here's what I want to kind of finish up with today, just as a planning tool going forward. I know I have about 10 minutes left. I told you I try to keep it to 30 minutes. Is that the IC disc? I tell you, we got into the IC disc. I got familiar with it about 3 years ago. I know it's been around. It's not a revolutionary tax idea. But what we have here is a tax incentive that rewards your clients for shipping products or manufacturing or handling products that eventually end up overseas. And a lot of people have said, TJ, over the years I've heard people say, okay, what's the threshold? What do I got to be selling? How much product do I need to be shipping for it to make sense? And I've heard $1 million is the number, obviously, everybody hears a lot about when it comes to this area of tax law. But what you got to look at is you got to look at, number one, the profitability of your clients and where their product ends up, okay? Because what we're looking at here is roughly, if you're optimizing a disc, okay, your clients can reap about 2 to 4% of every dollar that they bill for products shipped to non-U.S. soil results in about a 2 to 4% tax benefit. So if you have $1 million of sales that end up overseas, you could have up to a $40,000 tax benefit. Because keep in mind, this disc is a separate entity that is taxed. Instead of that, it calculates a commission based off the income of a sale, of an export sale. That commission is a deduction to the operating entity and is taxed at a qualified dividend rate, which is right now 15% through 2012. And so it represents a pretty healthy tax savings for those companies that qualify. But what I always want to remind people, and this is something that's often overlooked when we talk about this, is number one, this is a prospective tax strategy, meaning that we cannot go back and amend returns. We can't go back and post-date the formation of an entity to get the tax savings. This is something that if you are a calendar year taxpayer and they want to start the IC disc for 2012, it would be a short year period beginning January 20th, 2012 through December 31st, 2012. But also the clients are rewarded not just for their direct shipments, so not just for that product they build and ship to Canada, or that product they build, ship to Mexico or Asia, but also their indirect sales. If they're shipping product over to another company in the U.S., and that company is then taking it, embedding that part in their piece of equipment and shipping it to the U.S., that indirect sale is also includable for the commission calculation. That's very important to remember. I mean, we have, obviously we're based in Indianapolis, and while there's not all of our work is in the Midwest, there's a good concentration of it in the Midwest. And you got the Cummins, the Caterpillars, the John Deeres, that really are obviously lean heavily on Midwestern-based tool shops. Well, those tool shops are making a lot of their product ends up overseas, even though it's being shipped to a U.S. plant. The key thing is, as long as the product ends up on foreign soil within 12 months of shipment, that's what really triggers that opportunity for the disc. There's multiple ways to calculate the disc. There's two ways that are really what we call safe harbor provisions. One is just to take 4% of your export gross receipts, and that's your commission. Okay, that's not your tax savings, that's your commission. That's your deduction on the operating entity and income on the disc. Okay, an IC disc is a C corporation making a disc election. The other safe harbor provision is 50% of your export net income. And what that allows is that's another safe harbor. Obviously, calculating net income, 50% is your commission. But we really feel where we bring value as a firm is doing this transaction-by-transaction analysis, this T by T, is where we really break apart all the transactions and try to maximize that income within those transactions, getting rid of the stuff that has lost money or your clients have not made money on, therefore increasing the profit and thereby the commission that you can deduct on the operating entity and is shown as income, taxed at 15% on the IC DISC. Like I said earlier, optimizing the commission yields a tax benefit of 2 to 4% of a company's export sales. So it can be very lucrative, especially in the environment we participate in where so much gets shipped over to Asia. What's considered an export good? An export good is something that is manufactured, produced, or grown in the U.S. The export property must be held for sale or lease outside the U.S. What happens is you can't. We had this great question by a client about a month ago. A lot of their products went actually to U.S. bases. They were equipment that the U.S. military buys. Well, it may be shipped over Afghanistan or South Korea, but it's not. We don't know it's going to stay there. It may be shipped back to the United States. We don't take the disc on that. If it's consumed overseas, we're going to take the disc on that. If it's obviously, we know it's going to stay with relatively certainty, it's going to stay outside the U.S., then it is definitely going to be something that we want to include in the disc commission. It's important that in today's world, when we have so much product coming in from overseas, that no more than 50% of what your clients build or manufacture or assemble contains imported content. At least 50% of it has to be U.S. sourced content for it to be included in the DISC calculation. Engineering and architectural services can also be considered qualified exports for the DISC commission. Flow-through structure. Now, here's where we have some options. Most people, the DISC really doesn't benefit large companies typically, because the C corporation does not acknowledge this dividend. However, what's important to keep in mind is an S corp can own a DISC. Okay, the C corporation, if it's a small business, closely held business, the family could own the DISC. And so there's a lot of flexibility in who owns the DISC. The only thing that we can't have is a C corp on it because it doesn't recognize that qualified dividend rate. So we just want to create a little picture here of what it could look like here. You have the shareholders, you have a DISC, you have an operating entity. Okay, the DISC charges the operating entity a commission based off that, either 4% of sales, 50% net income, or the T by T methodology. The DISC then gets that as income, and that's a qualified dividend taxed at 15% on the. If it's not owned by an S corp, it'll appear on the K1. Setting up the DISC. That's we look at it at McGuire-Sponsor. We try to be a turnkey solution. So if you have a client that has a DISC opportunity, we're going to try to do all the legal documents. We use a firm here in Central Indiana to handle that, as well as do all the calculations and preparation of the 1120 Schedule P. Some basic things to keep in mind: that this does need to be a separate entity. It has to have its own articles of incorporation, has to have its own checking account, and it has a capital requirement of $2,500 at all times for it to be considered to qualify as this DISC, this separate entity. But what really is nice is that the IC DISC is transparent to the customer, meaning that it's not like we have to set up a different entity that bills the client directly. It's really kind of it's something that's very transparent, and we track at one time at the end of the year. We go back in and do obviously journal entries and computations to determine what that commission is for the entire year. It's not something where you're not adding a burden of labor on the controller or the CFO or purchasing or whatever the case may be. But there obviously are some key things we have to have. We have to have a sales agreement between the operating entity and the IC DISC. There is a certain window of that the DISC must be calculated, and then another window of when the final commissions must be paid. we have to have, obviously, the annual tax returns due 9/15 typically if it's a calendar year company. The DISC must have the same calendar year end as its owners. So if you have a fiscal year entity, if you have a fiscal year client and the owners are going to be the family or one or two people, then you're going to have a timing issue with the commissions recognized by the operating entity and the commissions shown as dividends, qualified dividends to the owners. I know I went through a lot of stuff here, and I apologize. I'm experiencing a little technical because I'm not seeing my window here, my dashboard, and here it is back up. What I like I said, today's goal was not to give some huge, tutorial on each thing. It's just giving you buzzwords to look out and remind you that McGuire Sponsor is here to assist you in any way. And so what I would suggest, if you have an R&E credit opportunity, even if it's something that you've used another provider for, your clients use another provider, and you want to have them take a fresh look at it, I would reach out to me on the R&E credit. If it's a cost irrigation opportunity, a 179D, energy efficient building deduction, contact Dave McGuire or myself. It's if an IC disc, contact me. But all that said, if you have an opportunity, call us. We don't have a problem putting a little skin in the game in terms of doing some projections for you and your clients, okay, to determine what is a good opportunity for them. If it's a DISC commission, the time of year we're at is great because we can hopefully maximize their benefit for 2012, but we can also do the equal look at their 2011 transactions to project what their benefits are going to be. Okay, if it's an R&E credit and you've calculated internally, or they've calculated it and you've put on the 6765, and you want to have them take a fresh look at it, there's been court cases over the past couple of years that have been very, very supportive of taxpayers in terms of taking the R&E credit, but building that qualitative claim, providing that nexus is key. For cost irrigation, obviously that is something that's been around for a few years, and given the fact that a depressed real estate market has made that a little less, a little more challenging in terms of finding good opportunities, I would still welcome the opportunity to talk to clients about how we can save them money through those methodologies, especially if they're getting ready to build a building. Explain to them, the pros and cons of the construction to maximize the depreciation. If it's 179D and somebody's calling them, trying to market that to them, and you need to help, get us on the call. So I know we didn't have any questions come through during this. I know I covered a lot of ground in a short amount of time, but today was really about serving as a reminder that McGuire Sponsor is here. This webinar will be posted on our website. Feel free to let me know if you have any questions directly. I'm in the office the balance of the day today. I've been trying to travel Mondays and Tuesdays. For those of you who know, I travel quite a bit. I'm always trying to be in the office Thursday and Fridays, and then Saturdays during tax season for our clients. So I definitely appreciate your time, and I wish you the most success for 2012. And please don't hesitate to let us know if we can help you with anything regarding your clients. Everyone have a great day. Take care.
不是1小时吗？不是只有半小时？不是还有另外一个人要讲？